Screw the banks. If you've ever wondered about buying a home without using traditional financing, this is going to be the video for you. I deep dive into owner financing, addressing both the benefits and disadvantages of using this creative financing method. So watch the whole video so that you can make an educated decision when going to buy your dream home. If you're new to the channel, I'm Connor Downey, licensed real estate agent in Atlanta, Georgia, and I keep everything so real about real estate that you'll never want to talk to another agent. This video is going to be longer than normal, and you guys will be welcome to go back and take notes. First things first, we are going to talk about what is owner financing. Owner financing is the process of you as a buyer obtaining credit towards a home purchase through an individual rather than a bank. Specifically, the owner of the home or the seller of the home. These do not always have to be true, but this is almost always the case with an owner finance or a seller finance. I say it's not always the case that an owner financing or seller financing that you are receiving credit from the owner or the seller. This brings into question what we call subject to. Sub to or subject to means subject to the original mortgage. That means that you are taking over the terms of someone's original mortgage. This individual may not even be the seller or the owner of the property, because there are certain situations where someone is using creative financing to provide an owner financing situation to an individual such as yourself or any other person that could be in the equation. We're gonna head over and check our little notes now. Quick recap. Owner financing is obtaining credit to purchase a home from the seller or owner directly rather than a bank, credit union, or traditional lender. What does that mean? So in order for you guys to purchase a home, whether it's owner financing or traditional, you are going to need to obtain credit. That sounds extremely wild to think about, but credit means money owed. It does not mean that you have the ability to get money. It means that you have the ability to borrow money, right? So credit is money owed, and debit is money gained, right? So if you have a debit card, that means that you gained money, you put it in your debiting account, and when you need it, the bank owes you money. That's why it's your debit. Now, when you use a credit card, you use it and you are now in credit to the bank accounts. I hope that makes sense for you guys all. That's why you need to obtain credit, whether it is a traditional financing or an owner financing. What does that really mean for you? Well, in order for you to obtain credit with somebody, let's keep it as simple as this. You need credibility. Even with owner financing deals, often at times, the person who is the owner or seller is going to look for some sort of credibility in your payment histories throughout life, whether it's your tax documentations, your bank statements, or sometimes these guys still pull your credit profile, guys. This is not always the case, but be prepared because each owner finance is different. That is the craziest part about owner financing, seller financing, or creative financing in general. They are always different and unique. Let's get back to taking notes. I know I just covered a lot. So owner financing, let's say it's always different and unique. You will need to provide proof of credit, right? Again, proof of credit does not always mean your credit profile, but can be. So examples, tax returns. That's very common. I see them ask for tax returns very frequently. If you don't have tax returns, bank statements. They'll ask for years of bank statements. 1, 2, 3, 4. I declare a thumb war, bank statements. If they're not asking for bank statements, they may do a credit pool. Now, just because they do a credit pool, it doesn't mean that they're looking for the same standards as someone who traditionally finances a home. Their credit pool may be willing to accept below 600 or even below 580 credit score. Now, a bank is traditionally going to look that you have at least a 580 credit score to qualify for FHA. That is not the case in owner financing. With the owner financing, there may be a minimum credit score. There may not be a minimum credit score. This I can't tell you until we find the property and we begin negotiating, right? However, if you get into this situation where you have a bankruptcy, or you have a foreclosure, or you have a couple cars in collections because you started a rental car company when you were 16 and you put it all on your credit cards and now you just can't recover, but you're cash flowing $300,000 a year, then you should likely still be able to get into the owner financing because you can provide proof of assets. So if you can provide proof of assets and income, traditionally these owner financing deals are going to work out for you, even if you don't have the reliability on your credit profile. That being said, owner financing can be very, very beneficial, but with you having less credibility, there comes a catch-22, and that is the down payment. So with owner financing, there's typically a very high down payment. So let's add to our notes, typically a very high down payment. So that is what owner financing is, right? Let's really I know this typically a very high down payment sounds like a negative thing, right? But it's just the reality of the situation. It's very typical that you're gonna have a high down payment. So let's talk about the positives of owner financing, right? Let's talk about why people do it. Let's talk about who may need it and if it makes sense for you to do it. Now, the positives of owner financing. Typically, owner financing does not appear on your credit profile. While this is a negative and a positive, it's kind of a neutral thing. Neutral benefit, right? What this means is that if you decide to build up your credit and you want to go and purchase a home through a traditional method, there's a very high chance you can still do that while owning an owner finance property. Reason being, it's not going to show up on your credit profile. It will, however, show up on title. I'm going to put that as a little note. Will show up on title for underwriting. So when you go in and you are looking to buy a new house using traditional financing, your owner finance deal that you have is going to show up on title. The reason being, if you go through the process with me, we have formal paperwork, we took it down to a title company, we registered it, and you have claims and interest in the property that you bought. It's an owner financing, it's a sale. It's the same process as going to the bank. If you are watching this video and your family or yourself, you've done an owner financing deal without the paperwork, you are going to be royally screwed. Absolutely royally screwed. We'll save that to the end of the video where I cover the negatives, but we're gonna get into the negatives. Trust me, I love talking about negatives. I like keeping it real. So the positives list may be shorter than the negatives list, to be honest, but there are a lot of great benefits to owner financing. So it's not gonna show up on your credit profile. It will show up on title. So once the attorneys get their hands in the mix, they're gonna know that you owe on this property. The catch-22 is, who is servicing the debt? On an owner financing, you are paying the seller or the owner directly or to a servicing company, and they are then providing the payments to either the owner, or they are providing it in some cases directly to a mortgage company. We're gonna cover subject to and all of that kind of stuff later on in the video. That's a different variation of owner financing, okay? So they are gonna make those payments. Those payments then will be reported that someone else is actually making them, which means that you're essentially renting, which means it's not a debt, which means it doesn't affect your debt to income ratio, which means you can still potentially, again, potentially is the key word there, you may still be able to qualify for another property to buy with traditional financing. This gives you variability so that you can own multiple properties without having a conflict of interest. So positives, potential to own multiple properties with no conflict of interest on your, let's say, credit profile. And this is because you will not have the owner financing count towards your debt to income if the title company can prove that you are not responsible for servicing the debt, and this can be verified only by underwriting of your traditional loan. That's a lot of information, guys. That's a lot of information. I know it seems like, right, like SpongeBob, but that's how it works, right? So we're really getting into the nitty gritty. I'm trying to keep it as factual and realistic as possible, right? So this is what's going to happen. It's a positive. You can keep it moving. You could maybe even just uproot from your owner finance house and go across the country and buy a new property. You could have multiple owner finance properties. That definitely is a fact. No owner finance is going to impact another owner finance. They're not going to be able to see that you have it in place. They're not running the traditional underwriting process, and they're not even really concerned with what title pulls up when you're doing an owner finance. So that being said, you can own multiple properties. It's really helpful. What are some other positives of owner financing? You don't need a Social Security to do owner financing. A lot of traditional banks require that you have Social Security. This is a great resource for people who are new to the country or still processing into the country, or maybe even a person who's here on work visa and hasn't even gotten the full rights to ownership. You can now acquire land here in the States without using Social Security, without using our international loan programs and jumping through all those hoops where they want you to put extra down payments, right? So there's not going to be some crazy reserve fees and those kind of things. You don't need a Social Security to do owner financing. What are other positives of owner financing? Negotiate your interest rate. So that's one of the coolest parts about owner financing. Some of these owners / sellers, they're really stubborn on what they're wanting. It's typically going to be the higher end of the market rates, but it's not always. You can also you have a chance. There is a chance you will get a below market rate. What really matters to the individual's owner financing or seller financing is how much you're giving them every single month. When they look at it in perspective of the accumulated interest, they feel like they're making a lot of money. They may sell you the property today at $800,000, but the interest that you pay over the life of a 30-year loan to them is exponential. It may be closer to 1.8 million by the time you finish making all your payments, whether or not they're charging you 4%, 6%, or 8%. I want to give you guys a quick example. You can skip through the story if you want. However, this is actively a house I'm under contract on. I located a house in Cumming, Georgia. That's Forsyth. That's going to be very, very, very close to Lake Lanier. This home is going for $700,000, and the monthly payments expected are $3,500. The seller financing deal, they asked for only $35,000 down. This is $35,000 on a $700,000 house. They just need to immediately assume the mortgage payments at $3,500 after placing their $30,000 down, and they own a beautiful 3,400 square foot house on 2 acres, 10 minutes from Lake Lanier. That's crazy to me. They didn't go through bank financing. They didn't even have a verification on their income. We just simply had to offer proof of funds that they had the down payment. And then they turned around and paid little old me out of their own pocket. So these things happen. It's realistic. Their interest rate, 3.6%. Guys, that's unheard of. If you're watching this video today, it's 7/30/2024. Interest rates are sitting close to 5.4% for FHA and 5.9% for conventional. 3.6% interest rate on a $700,000 house and they're entering the house for $30,000 down payment. Oh my gosh, guys, let's do the math there real quick. I don't even, so 700, what is, let's see, traditionally you put 3% down. So they got away with doing a traditional bank finance essentially, but they don't have to use their credit. This isn't gonna go on their credit profile. And I'm gonna be honest, not to put my client's information all the way out there, but they didn't file their taxes for the past few years. So that's another huge benefit. Do not need your tax returns every time. Only some owners / sellers ask for tax returns. Isn't that crazy? You can get into a $1 million house with no tax returns. You can get into a $1 million house with no social security. You can get into a $1 million house as long as you have the right down payment and you're willing to pay what the seller needs every month. Because the seller needs to make money. You're a liability. You're moving into their property. You could literally go in there, pull out all the things that they left, the appliances, the copper, the PEX, it doesn't matter. You could be crazy. And you just steal everything out of the house and they're left with the house. They're left with a vacant property that's been vandalized by you because you gave them $20,000. It's a lot of risk. Taking on owner finance is a lot of risk. And you may feel like, oh my gosh, this person is predatory lending. Owner financing is not predatory lending. Both parties knew what they were getting into. And as long as it's a signed and bound contract with the buyer having rights to title, I think it's a very fair and equitable move. I think that people are over exaggerating when they think it's predatory lending. The banks are predatory. The banks are adding points. The banks are asking people to buy down rates. The banks are making people not qualify for homes who are paying 3 times their income in rent. So banks are predatory. I'm going to be the one to say it. Banks are predatory. And if you think that an owner financing situation makes more sense for you, I'm going to advocate. Give me a call, head over to the description. We'll do a consult. We'll see how much money you guys have and what you can afford. That being said, what are some other positives of owner financing? Because there's a lot of them. So with owner financing, you can make equity. So generate equity in the property versus renting. So a lot of people, they can owner finance just as well as they can rent. So if you're going to go and do this, at least you're gaining equity in the owner finance, right? Versus renting. And I say all that because you can still sell the home. You have full rights to sell the home. Let's go further. You can still refinance the home as well. So you have the rights to sell the home in an owner finance. You have the rights to refinance the home in a seller finance. Why is that so cool? Because if you get into a house and it's under market value, you're doing all of these things, you finally got your credit correct, and you got a terrible interest rate in your owner finance. It's the exact house that you wanted in the perfect location. So you agreed to the terms. You can now sell that house, pull out the equity, go buy a house traditionally. You can pull out the equity, go find another owner finance, or you can refinance, pull out your equity, and no longer have the owner finance. You now have a traditional bank mortgage rate, and you decide, screw it, I'm going to go file bankruptcy and I'm not gonna owe these people anymore, because that's just how bankruptcy works. It doesn't really work with the owner financing. Let's get into that. As I said, we're gonna get into it. By it, I really mean the negatives. So you can still refinance the home. You can still sell the home. But if you were to hypothetically file bankruptcy, let's talk about that avenue, the negatives of owner financing. So try and get our notes going here, guys. So if you file bankruptcy, there is a high chance you will lose the rights to the property. Why is that? Well, you have claim on title, right? But when you go and file that bankruptcy, it's gonna wipe out the debt, right? But the thing is, it's an owner finance. So original title is still in the owner's name. Versus where if you file a bankruptcy and the bank owns title to your house, they're going to negotiate and they're going to try and get your payments lower or include it in your bankruptcy, or it's going to be protected by homestead exemption. In some owner financing cases, you aren't able to even claim your homestead exemption, right? You kind of lost a step of authority. You can still apply, you can see if they'll apply it. And if you have the homestead exemption in place, when you go to file bankruptcy, there's a certain level of debt that's protected, which is your primary residence. If it's an owner financing, you may have complications in securing that asset and saying that it is yours that can be protected under the bankruptcy. Again, I'm not a legal professional at this moment, nor am I a financial advisor at this moment. However, these are things to keep in mind, right? So if you file bankruptcy, there's a high chance you'll lose the rights to the property. But that's an extreme situation. What other negatives can occur with owner financing? Well, in a situation where you want to sell today, guess who is your debt servicer? The owner of the property. Let's say the owner of the property is in Cancun. You haven't heard from him in 18 weeks. You've been paying on time, no problem. They accept the payments. The issue with it is you may have an emergency and you need to sell today. You need to sell it yesterday. You had somebody pass away. You got to pay for the funeral. You got to pay for everything. You got to liquidate. You're selling the house. You get down to title. You found the buyer. They've deposited the cash. And now all of a sudden the attorney hasn't heard from your owner / seller / the lender to get the final docs on the payoff. They need to know exactly how much have you paid off on the loan. It's a loan just like any other loan. It might not appear on your credit profile, but it needs to be paid down. So they're waiting for this ledger, and the ledger never comes from your seller. And your buyer backs out, and you're still stuck, and you're looking stupid, and you don't know why, and you haven't heard from the seller. They finally come back months later, and they say, hey, I'm so sorry. I got all these emails from the attorney. I heard you were trying to sell the property. What happened? Well, we couldn't release the funds and we couldn't complete the sale because you didn't tell them how much I still owe on the mortgage. That's crazy, guys. That can hold up every little bit of your transaction because you don't know how much is left on the mortgage. Even if you have provided documents, whatever that seller says on the documents is what the attorneys are going to say. Hey, that's the final balance. Now, you don't have to agree. That money won't be released if both parties don't agree. However, if you bicker back and forth for months on end, they'll hold the money for months on end. The deal won't close for months on end. Hell, they'll sell the property if it's a cash transaction, and then they'll hold the money. So neither of you have rights to the property. Neither of you have rights to the money, and the money is in limbo. So a negative of owner financing, you may get stuck trying to sell the home as you await proper documentations from your seller / lender / owner, right? There's delays. This is a human being. It's not a corporation. They're not functioning on the same level as what you would expect if you were just dealing with an automated system. Bank of America, Navy Federal, Chase Bank, it doesn't matter. It's not the same, guys. It's not the same. So we get into that. And you might need your money now. And it goes back into how much money did you put down on the property? You may have given this person typically 10%. Typically, that's typically a good starting point. The banks are asking for 3%. Banks only ask for 3 to 20% down, while owner financing typically asks for 10 to 30% down. That's crazy, guys. So if you came up with 10 to 30% down and you're sick of this home and you need to move and you need to go now, and that money is tied up, there's no real ramifications. The seller could die. The person financing you the home can die. You need to have all of this stuff in writing, and you need to have a debt servicing company. You need to have a debt servicing company to verify your payments or else you will be screwed if the seller dies. If the seller dies and nobody can verify how many payments you've been making, all of this, the contract, ownership rights, depending on the contract, is going to go on to their heirs. Then you're now dealing with a father, mother, brother, son, sister, cousin, uncle, brunkle. It doesn't matter. They don't care about you. They don't care about the deals. They don't care about honoring it. Now you guys have to fight for title ownership. Or if you don't fight for title ownership, you're going to have to convince them that you're free and clear, you paid what you paid, or alternatively, you just sell it and move on. But somebody's going to have legal rights. There's a lot of complications that come into owner financing when you consider that your lender / provider may die. Because Bank of America, as an LLC, as an entity, as a corporation, they're not going to die on you. You're not going to just wake up and, hey, I called Bank of America, they're dead. Well, there's a chance all these banks might foreclose, bankrupt, go crazy. But there's bailouts for that. There's not a bailout for your owner finance deal. So I know there's crazy situations, other things happen. I'm sure someone's going to comment down below about how their bank closed and they had a mortgage owed. I don't care about that. We're talking about the negatives of this owner financing situation. So if your owner financer dies, it's going to be chaos. It's going to be true chaos. Let's be real. So we're going to go back to, you have all this money tied up. The down payments are crazy high for owner financing versus traditional financing. You may be able to, skate by. We even have a 1% down program if you only spend $350,000. That's crazy. So you could put way less money in traditional financing. The catch-22 with traditional financing is you also have to pay your taxes. So this video is great for people who don't pay their taxes or have a struggling ability to account for all of the loads of money they have and make a lot of money. My truck drivers, my vending machine operators, my drug dealers, all of those guys, they have great assets and cash flow, but for some reason you don't file taxes. And I'm not here to judge you because I make a good bit of money and I don't like to file all of it on taxes either. But that's not the point, guys. It's not the point. There's some benefits of going with owner financing. There's a lot of negatives. There's a lot of positives. There's a lot that goes into it. So let's see. Who is owner financing good for? That's important. Good for. It's good for people struggling to have a down payment and their tax payment at the same time. That's really what the problem is. Taxes may want you to pay $40,000 to claim the quality of life that you want. That's crazy. You could just put all $80,000 because you're going to need a $40,000 down payment and $40,000 in taxes. Put all $80,000 into an owner finance and buy yourself a mansion. I can get you $1 million house. Hell, at the end of this video, we're going to go find an owner finance just to give you guys an example of what that looks like and how I can do it super simple for you. So people struggling to have a down payment on their taxes, people without citizenship, great for you. People with low or no credit, people who own multiple other residents and have a high debt to income ratio. So owner financing is a really good idea if you're looking to secure a vacation home or another investment property or those kind of things. It's really good. It's really helpful. Investors looking to leverage other people's money. So if you can find an owner finance and the terms are really good, the mortgage payment for you is low every month, you throw this sucker on Airbnb and you're cash flowing 2 times what you're paying. That's crazy. You can even just throw a traditional long-term rent in there and they're paying the equity down and you now have an asset that you put 10% down on, maybe even less sometimes, whereas the bank was demanding that you put 20 down on your investment property. So you won't even have to use your credit profile. You don't have to do any of that. This can be very helpful. So owner financing is good for investors looking to leverage other people's money. Opium, don't forget that, guys. Good old terms. Who else is owner financing good for? Owner financing, retirees, retired people, and those on fixed income. I'm sure there's other people who can really benefit from owner financing. Drop your scenarios down below. Help other people get an idea of what creativity can do for you. But for now, I think this is a good coverage of who owner financing is good for, who should be considering it. It's not really great who owner financing isn't a good fit for. Let's see. Oh, well, let's go back up here. People who want to own a home worth more than the bank approved them for, right? Because you can own the house and on paper, you might not look like you can afford it, but you know for a fact you make that money every single month and the bank approved you for $500,000 and you and your family want $1 million house. Let's do it. Let's sit down and have a consultation and talk about, can you financially afford this every month? Will we be able to find it? How much do you have as the down payment? And what do you expect out of these terms? And once we figure all that out, it's golden. We can find you $1 million property, even if you were only approved for $500,000. So it's not good for, I want to say, first time home buyers with good or great credit and paid taxes. Don't do that. If you have all of these covered, good or great credit, you're paying your taxes, you have decent income, go and apply for a traditional loan first. Go ahead and just do it. It takes a lot of hiccups out. There's less deception. There's less small things that can go wrong, right? In the seller owner financing, you're depending on the owner to update you on any changes to taxes and insurances. And that changes whether or not you go with a bank. There's a servicing company, they let you know, and that's called escrow. Escrow updates, you get charged, they pay it forward, blase, blase, blase. That way you don't have a tax lien on your property. If you're dependent on an individual rather than an organization who has this going, they make mistakes. These organizations make mistakes. Now, imagine if a person is left up to managing a 30-year mortgage for you. They're likely to make mistakes, guys. So it's better for a first-time home buyer or a person with good credit and paid taxes to take the traditional route, get comfortable, know what to expect. If you can't do that, then let's talk about owner financing. There are plenty of first-time home buyers who do the owner financing route. I've helped them. I'm happy to help them. I would just really prefer if you went the traditional way. However, there's more liability of that. There's not as much closing cost. Not as much closing costs on a owner financing. Why is that? Because it's a cash deal. That's crazy, right? It's a cash deal. So traditional financing, it's not a cash deal. You're being charged by the lenders additional origination fees or points to get your interest rate lower and those kind of things. And it's extra. $1,000 here, $2,000 there, $3,000 here. It's a lot, right? So when you go with the non-traditional, you're gonna find yourself paying less. Paying less at close goes a long way. You can put that money in your pocket. You can put that money towards a mortgage payment. But that's just the reality. So owner financing is good for that. But who is owner financing not a good fit for? Someone who is on the verge of death. I know that's bleak, but don't go and start a personal contract with somebody that can't be honored by your kids or your family later. It's going to be more complicated. Just don't do that. Leave them to deal with the banks who have steps and process and are going to honor the deal. Leaving this to someone to deal with after you passed away, that's a lot. Taking on an owner finance for personal reasons, that's great. Do it, take control, take the bull by the horns, as they say. It's a great opportunity that way, but otherwise, do not. If you're on the verge of death, it's not a good fit. Let's see, someone without consistent income. Just because it's an owner finance and it's not going to show up on your credit profile initially, they could still come and try and get a debt servicer after you and send you to collections and have it tear you up. And there's ways you can still be evicted. So don't think that you can't. You can still get foreclosed on. You can still be foreclosed on you're less likely to have grace periods for missed payments. Yeah, so like guys, if you have a bad history, of paying on time, this isn't the move for you, because they're gonna take your down payment and lickety split get you out of that house and take it back. They don't care about you, they don't want you in the house, and yeah, you're just another number to make money off of. Now, there are some people who are sympathetic, but let's not even assume that. Let's just always assume that people are after money and themselves and their families, and not you, because you're not part of them and you're not part of their family. So loyalty can sometimes be deeper than blood, but in the case of money, let's just assume that they're not loyal to you. So it's not a good fit for first-time homebuyers that you have everything together, someone who's on the verge of death, someone without consistent income, and if you have a bad history of paying on time. I do not recommend doing owner financing. It just leaves your ass out in the wind. You're gonna be more liable to lose the property, and ultimately my goal when you guys are buying properties is to secure them for generations on as well as present. So this altogether is a lot. It's a lot of information. As I promised, we're gonna go ahead and find a house for you guys to look at owner financing wise. And if you liked the video, comment down below if this was helpful for you. I will do some more improved videos. This is just my first time doing a note-taking type video side by side with you guys. So just give me feedback, let me know how you like it. We're gonna head over to Matrix MLS and get signed in here so that you guys can find an owner finance with me. So we'll go to residential. We're gonna keep it simple. We're not gonna put any budgets. We wanna just show you guys what's out there. So we go in here, we do owner finance, boop, 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 boop. It's gonna be limited. There's one, right? So if we add the ing, owner financing, what do we get? We get 44. So don't do the owner finance, search for owner financing, right? This is how you know I'm a good real estate agent, guys. Some people really don't even know how to do this. So let's do a portal side by side. There's about 50 listings, so we can see them all. Look at these beautiful houses that don't require banks. 2.9 million. So let's go back to this list real quick. Positives of owner financing. You can buy a house that may not have ever qualified for a traditional mortgage. Some of these luxury homes only qualify with specific loans. They're called jumbo loans, and not all jumbo loans are created equal and even go up to the purchase price that some people are looking forward to buying. So keep that in mind, like this $2.9 million house, that's crazy. 2.7, 2.1. I want to find something realistic for you guys though, like an everyday home. Like it's nice for us to look at these luxury properties, but let's see what the most everyday affordable house is right now. Fairburn's a really cute area. I mean, this is a decent house. Let's use this one, right? It's not my favorite of them, but let's use it. So it's 4 bedrooms, it's 2 bathrooms, it's 2,000 square feet, it was built in 1981. Let's take a look at these pictures real quick. It's cute, it's cute. It's got a nice little accent wall there. It's got carpet, it's nothing special. So let's see, price to sell, owner financing option available. This is the one. Okay, well, this isn't the one because it's not showing us exactly what the terms are, but it is openly offering owner finance. It's really cool. I want one that gives you guys an idea of what you can expect. I love McDonough. This is a gorgeous house. Let's see. So owner financing is an option with this home with so much attention to detail. Again, they're not telling us how much for the owner financing. Let's see. Portal side by side. Let's go to the expensive one. Let's see. Okay. Appointments only. There are no financials available. Owner. Oh, so this one actually came up because there's no owner financing. Isn't that crazy, guys? So we're just on a search right now. Let's see. Owner have anything for owner? Seller, owner financing. Wow, 50% down payment and proof of funds. This person's wild. This is where it doesn't make any sense. Why would I ever give you half for you to owner finance it? Why would I do that? I just go to the bank. Dumb. They're dumb. All right. Owner financing available. Anyway, guys, a lot of the times they don't publicly advertise what the terms are. It's just a liability. They can't do that. They'll put them in the private section sometimes because agents can read it. And this one's good. Look at it. This is a good example. Please call our text listing agent, blah, 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 blah. Don't call them, call me. Seller will entertain owner financing at 4.9% for the first year, and you have to do 35% down. But let's look at this. This is in Cherokee. This is really close to the lake. Obviously, it's on the lake itself. Beautiful water, beautiful lake home. Back to what we said, if you're looking to buy a vacation home or a recreational property, it may make a lot of sense to do owner financing. It's not going to show up on the bank. You're able to get what you want. This is gorgeous. This is gorgeous. 35% down. It's reasonable for what you're getting. You could probably negotiate that down into the 15% mark in my hopes. They may really want 20%. And the reason you might do this is because you can't qualify for this house with your traditional income. You might have a house already at $500,000, $600,000, and you know that you make good money, or that you know that your retirement account over the life of it's going to pay for this house, and so you decide to go forward with an owner financing instead. I mean, they have such great options. There's a lot of opportunities. Some of them are more expensive than you guys might have expected, but some of them are extremely affordable. So don't forget, there's varying types of homes for sale. There's varying owner finances. They all have different terms. They can be positive, they can be negative. That may be a good decision, it may be a bad decision. But ultimately, if you're going to make this decision, don't do it without consult, don't do it without help, and expect to pay the person helping you. Everything's not free. You got to keep in mind that if it's on market, you got to pay for the agent and the down payment. If it's off market, you still have to pay for the agent who found it for you. If you found it for yourself, good for you. I hope you used this video so that you made a bang up decision and you didn't screw yourself over. But you know, you can do it by yourself. People do it day in, day out, by themselves, making cold calls, sending out mailers, finding a home for their family, owner finance, putting only $10,000 down on $1 million properties. It happens. But if you want to do $10,000 down on $1 million property, don't call me, because I'm not the guy to waste my time, because where do I get paid for that? But I will educate you on how to do it. You can pay me for a consult and I'll walk you through it step by step. You can retain me and I'll walk you through it step by step. But don't think that you're going to do an owner finance and not pay me. That just doesn't work. You're not going to not pay your agent if they help you guys. So don't contact an agent unless you're prepared to pay the primo for you to get into an opportunity like this. Otherwise, call your agent and ask about traditional financing, because that might be a better fit for you if you don't have the cash and you feel strapped by doing an owner finance. Thank you guys for watching this video. I know it was extremely long. Head over to the channel for other content just like this. I do housing market updates, home tours, and give you the real estate realities here in Atlanta, Georgia. So subscribe to the channel. It means the world to me, and tune in next time.